There are 3 rules from Warren Buffett that changed how I think about investing. And I'm not talking about the quotes that you've probably heard already 100 times, such as be greedy when others are fearful. Those are great nuggets of wisdom, but they can be hard to apply when markets get rough. I've spent over 30 years studying Buffett's principles and thinking about how to apply them into real-world investments, all while growing my firm, Ridgewood Investments, and managing money for many high net worth families and individuals. One of my most thrilling experiences of my life happened in 2002 when I attended my first Berkshire Hathaway annual meeting in Omaha, Nebraska. A lot of people know this meeting as Woodstock for capitalists. Back then, fortunately for me, there were only a few thousand people attending the meeting, which has now grown to over 40,000 people making the trip to Omaha each year. And what made it so special to attend that year for me is that I got to meet the man himself in person and chat with him, as you can see in this photo that I took at the time. Of course, I was quite a bit younger at the time as well. That experience of meeting one of my gurus showed me something that most investors completely miss. And that is that there's a big gap between what people think Warren Buffett does and what he actually does. In this video, I'm going to share the 3 most powerful ideas that I learned from studying Warren Buffett carefully and reading many books and reports on how he does what he does. And these 3 principles that I'm going to share with you completely changed how I invest. And I'm going to explain how you can start using these same principles in your own investments as well. The first rule is what Buffett calls long-term orientation. And when I say long-term, I don't mean a few days or a few weeks or even a few months. I don't mean 1 or 2 years. I mean thinking in decades. Buffett once said, "Our favorite holding period is forever." And he means it. Let me give you an excellent example. He bought the stock of Coca-Cola in 1988. And guess what? It's 2026, it's the beginning of the year. He still owns Coca-Cola today. That's over 35 years. And here's what happened in that time. His original approximately $1 billion investment in Coca-Cola stock is now worth over $25 billion. And get this, the dividends he receives each year on his investment now exceed his entire original investment. But here's the problem. Most investors don't and can't think this way. The average holding period of a stock today is way under 6 months. Back in the 1960s, it was many years. We've gone from thinking in years to thinking in months, and in many cases, thinking in days or minutes or even seconds. Why does this matter? Because time is the friend of the wonderful company, the wonderful investment, and the enemy of the mediocre. When you own a great business and you hold it for decades, you're letting compounding do its job, do the heavy lifting. Every year, those earnings get reinvested. But when you're jumping in and out of stocks every few months, you're paying taxes every time you sell, you're often paying transaction costs of various kinds, you're paying trading fees, you're constantly trying to guess what the market will do next. And here's the reality. Nobody actually knows. And study after study has shown that the more you trade, the worse your returns. This is why once I understood this principle, I started to hold companies. I started to research very carefully the companies that I would invest in, and then I started to hold them for much longer than most investors. Let me give you a perfect example. The first stock I actually ever purchased was a company called Procter & Gamble. Most of us know Procter & Gamble because they make very famous brands like Tide for detergent and Bounce and quite a few other home household goods and products. Now, Procter & Gamble is an excellent company. A friend of mine was working at Procter & Gamble. So when I was in law school back in 1992, it was the first stock that I purchased, and I purchased it through a dividend reinvestment program. The amazing thing is I still own that stock. I bought it in 1992. It's now over 30 years. I still own the stock. It's done very well. And similarly to the example of Buffett, obviously on a much smaller scale, every year today that I own Procter & Gamble, it gives me dividends of almost the amount that I originally invested, which was only $1,000 at the time. Remember, I was a student. So the key here, as I explained, is that we have to find those companies which are worth holding over the long term and then let compounding do the work, as I did in the example of Procter & Gamble and as Buffett did in the example of Coca-Cola. The reality is that when you take this type of a long-term orientation, it really pays off, and patience pays you back especially during market downturns. As an investment advisor, of course, I do the research to find great companies, and I coach my clients and I educate them to think long-term and hold on to holdings long-term, and obviously also take advantage of market downturns to add to excellent companies. Over many, many years, this type of patience and compounding really pays off. One of my first clients was my parents, and their portfolio has grown an incredible amount in the years that I've been managing it. And we really have applied this principle to excellent effect for them. I can't give you the numbers because of regulations, but if you want to understand the power of compounding, that's what I would suggest. And during the time when I've owned Procter & Gamble or Buffett has owned Coca-Cola or my parents' portfolio has grown, there's been many reasons to panic, many market ups and downs. The beauty of taking a long-term, multi-decade perspective to your investment holdings is that it really just takes all the noise out of the equation and allows us as long-term investors to ignore the market and simply be patient and take advantage of opportunities when they arise. So, how do you actually apply this principle in practice? Here's what I'd suggest. Before you buy any stock or any investment, ask yourself this question: would I be comfortable holding this position or this stock for 10 years or more, even if the market shut down tomorrow and I couldn't sell it for that entire time? If the answer is no, you probably shouldn't buy it in the first place. And this comes right from Warren Buffett. And if you already own stocks, stop checking the price every day. Set a rule. Maybe you look at your portfolio once a quarter or once a year. The less you look, the less tempted you'll be to make emotional decisions or make a lot of changes to your portfolio. Unfortunately, in this world of Robinhood and prediction markets, attention spans are getting shorter, not longer. And this is going to be challenging for most investors to do well in their portfolio given their very, very short attention spans. And by the way, if you're someone who wants help applying these kinds of principles to your own portfolio, that's what we do at Ridgewood Investments. There's a link in the description if you want to have a conversation. Okay, let's go to the second rule. So the second rule changed everything about how I evaluate investments. And this is what Buffett said about it. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Now, this might sound obvious, but most investors do exactly the opposite of this rule. They get excited when a stock looks cheap. Maybe it's trading at a low price to earnings ratio, or the stock price just dropped 50%. They think they're getting a bargain. But Buffett learned early in his career that buying mediocre businesses at cheap prices, what he called cigar butt investing, doesn't work very well. Sure, you might get one last puff out of that cigar butt and make a little bit of money, but it's still a cigar butt. It's not going to be able to compound your wealth for decades. What you want instead is a really wonderful business. And by wonderful, I mean a business with a durable competitive advantage and a long-term pathway to grow. A business that will still be thriving 10, 20, or 30 years from now. Think about, for example, the brands that you use every day, the products you'd never switch away from, the companies that seem to just keep getting stronger. Those are wonderful businesses. And Buffett has many of these types of businesses in his portfolio. Buffett, for example, has held American Express for many decades because of its brand power. As I mentioned earlier, he's held Coca-Cola for 35 plus years because people all over the world drink it, many of them every single day. More recently, he invested in Apple because once people are in the Apple ecosystem, they rarely leave. I'm a case in point. Now, remember, even after you find a very high quality business, you still do not want to overpay. That's why Buffett says a fair price in his quote, and not any price. But the key insight here is that a great business at a reasonable price will crush the returns from a mediocre or poor business at a cheap price, especially over the long run and especially after taxes. As I mentioned earlier, I have many personal examples in my portfolio, including Procter & Gamble, that I found through my pursuit of quality investing. I've also, earlier in my journey as an investor, had some mistakes where I bought a company where I didn't think sufficiently about quality, a cheaper stock that turned out to be cheap for a reason. An example that comes to mind is a bank in the mid-2000s that seemed very cheap based on the price-earnings multiple. Several years later, that bank got caught up in the financial crisis. That's an example of where something that looks cheap may turn out to be not a very good investment at all. So here's how to apply this principle. When you're evaluating an investment, don't start by looking just at the price. Start by asking, is this a wonderful business or not? And some of the ways to identify a wonderful business is to ask questions like the following. Does it have pricing power, i.e., do they have the ability to raise prices without losing their customers? Is the management trustworthy? What evidence is there of their trustworthiness and their long-term thinking? Will this company still be dominant in 10 or 20 years? Only after you've answered yes to these types of questions should you even look at the price. And actually, if you want to go deeper on this stuff and these principles that I'm sharing with you, I've put together a completely free guide called 7 Devastating Mistakes That Investors Make. It covers things like chasing performance, trading too much, and making emotional decisions. You can grab your own copy in the description. Okay, let's go to the third rule. Rule number 3, temperament over intellect. This is probably the most important rule, and it's about temperament. Buffett put it this way: the most important quality for an investor is temperament, not intellect. Now think about that. Warren Buffett, one of the smartest people and one of the smartest investors who's ever lived, is telling you that being smart isn't enough. He actually once said that you can have ordinary intelligence and still be an excellent investor. And what matters more is your ability to control the urges that get other people into a lot of trouble. And here's why this matters. Investing is as much, if not more, an emotional challenge as it is an intellectual one. Markets are driven by human psychology, especially waves of fear and greed that tempt investors into abandoning the sound principles that I'm sharing and that Buffett shares, usually at precisely the exact wrong time. Research studies show that the average investor dramatically underperforms the market, not because they pick bad stocks, but because they buy when prices are high and when everyone is excited, and they sell when prices are low and everyone is panicking. They do the exact opposite of what they should do. Think about March 2020. The market crashed because of COVID. The fear and greed index dropped to extreme levels. Many investors sold everything at the bottom, but investors who kept their cool and stayed invested, or even bought more, saw the market recover pretty quickly in that case and hit new highs within a year. This happens in almost every single market cycle. The people who can control their emotions and stay with long-term investing outperform the people who can't. It doesn't matter how smart you are. If you panic during a crash or get greedy during a bubble, you will almost certainly destroy your returns. Buffett's advantage isn't just his intellect. It's his ability to remain calm when everyone else around him is losing their minds. He said, "Be fearful when others are greedy, and greedy when others are fearful." But actually doing that requires incredible emotional control and a tremendous amount of discipline. And I've experienced this firsthand. I've been managing investments at Ridgewood for the last 24 years, but prior to Ridgewood, I've been managing investments for more than 30 years. And in that time frame, I've had multiple market corrections, including the emerging markets bubble in the late 90s, followed by the dot-com bubble, followed by the financial crisis, followed by COVID. So if I didn't have the emotional discipline that I learned by being a long-term investor and studying Buffett, I would have panicked any number of times. But fortunately, because I bought good businesses, I think long-term, and because I have cultivated the emotional discipline and stability to stick it out through market ups and downs, I was able every time to not only survive, but thrive as a result of these market corrections. During those time frames, for example, in the late 90s when there was a dot-com bubble, or even during the financial crisis when there was a bubble in housing, I continued to stay long-term focused and also think about fair prices. And as a result, I never really got caught up in the bubble phase. And then once there was a market panic, I was actually able to find opportunities in great companies that were on sale at that time. So how did I cultivate emotional discipline? Well, by reading and studying Buffett and looking at a lot of case studies and examples, I slowly began to reflect on my own emotions. And I always asked myself how I can become more patient and more long-term oriented. And gradually, as I practiced that, I got much better at it, to the point where today, even though I'm managing hundreds of millions of dollars for many families, market downturns don't really bother me. In fact, if anything, they excite me because I think about the bargains that I'm going to be able to take advantage of. So how can you build this kind of temperament? Here's 3 ideas that can help. First, Have a written investment plan. This way, when markets get volatile, you can refer back to your written plan instead of making emotional decisions. Second, stop watching financial news every day. If you subject yourself to the noise that is constantly out there around prices and the economy, etc., it's going to trigger emotional reactions that are going to hurt your returns. And third, remember that volatility is normal. Buffett has said that you should expect your stocks to drop 50% at some point. If you're going to be a very long-term investor, it's probably going to happen multiple times. And if you can't handle the emotions that come with that, then you probably shouldn't be in investments, and especially in stocks at all. So those are my 3 most important principles. If you got value from this video, please hit subscribe. We're going to put out new content every single week on value investing and wealth building and long-term investing principles that you can profit from. And if you want to keep learning, please watch this video next.